So here we are in front of an office which is selling houses. Can we say that the housing market is at the root of the financial crisis?
If you go across the Atlantic, you can see the roots of the crisis in the US housing market, where the availability of credit over the last decade or more has extended to people who couldn't really properly afford the kinds of mortgages that they were taking out, and fueled the US property market boom. But what happened was that the risks associated with the mortgages were parceled up into products which were then sold on to different financial institutions. And these subprime mortgage assets became part of the tapestry of the financial environment in which risks were being bundled up and sold and traded. And everything was going wonderfully until the moment when people began to make inquiries about how were these risks really to be properly handled once people began to default. So once you began to see credit defaults, people defaulting on their mortgage payments, then everybody began to get the big chill. The panic set in, the housing market in North America and in parts of Europe began to feel this chill.
So Adrian, the housing crisis, the subprime mortgage crisis was largely in the States, only certain parts of the States as well. How did that manage to have such a major effect on stock exchanges like this bourse here in Brussels on the other side of the world?
When the housing market crisis erupted and housing prices collapsed in the United States and have continued to fall, it led to a big downturn in the US stock market. It led to major problems for financial institutions, first of all in the United States. Big US banks and financial institutions, as we know, went into decline and in some cases receivership. So the stock markets of Europe, including the one at the bourse, have also experienced the effects of a globally integrated economy. This is a world economy, and the international financial systems are heavily linked. So we have been seeing the loss of confidence. We have been seeing the problems now of how to manage the big effect upon our economies and our economic lives.
You mentioned confidence there. Now clearly the drop in the bourse both here and around the world, that was a vote of no confidence, not just in the companies and the products, but also in the actual system of regulation and of the financial system.
Absolutely. The crisis that erupted out of the United States reflected some global seismic shifts in the movements of international capital, and this is a fundamental factor in what has been happening. But you're right that the confidence factor has really exposed the questions about whether the international banking and financial system was properly regulated. Was it sufficiently regulated? Were there too many risks being taken?
And you talk about the global basis there. What do you feel about the international reaction to this? Because there has been a large amount of cooperation on this, hasn't there?
I would say that the important G20 Summit in London in April was a historic effort to try and bring about greater international coordination in response to the crisis. It's clear that we have to take particular steps to manage the monetary stability of our financial systems. That still is something to be looked at, but the most important consideration was to try and harmonize the kind of fiscal stimuli which have been going in to try to take us more rapidly out of the recession which we are now unfortunately in, but more to the point would also provide the opportunity to provide some much needed capital injected into the banks and the financial institutions.
So some of the accusations about how we got into this position are that it was casino capitalism, that too many risks were taken. Is that a fair point?
It is a fair point. Back nearly 50 years ago, there was some development of models that seemed to provide a foolproof way of making money out of offloading and diversifying risks. And this capital asset pricing model analysis laid the foundations for the kind of the products that we have seen, the derivatives, and then these so-called subprime mortgages. And it worked fantastically well for as long as people were happy to leverage their risks in the way that was taking place it only began to fall apart when people began to ask fundamental questions about whether or not they were too exposed. And then, of course, we know, as we've discussed, the financial institutions, the stock markets began to find that they were in serious trouble.
And clearly one of the tenets of capitalism is you need to speculate to accumulate. That requires people to take risks. We're living in a risk-averse world now, so how do we get out of that conundrum?
This is a fundamental point of great importance, I believe, because historically we've always had these so-called derivative products where people do find ways of managing and unloading their risks, and it works out normally very well as a lubricant of trade. But as you rightly say, at the present time, there's a great concern about the extent of regulation required to manage these kinds of financial products and the work of financial institutions. I believe it's absolutely essential that we do not over-regulate.
So Adrian, you mentioned there the financial stimulus. Now clearly one of the large aspects of that was the bailing out of banks. For example, this one here next to us, Fortis Bank. That was part of a larger financial stimulus. The question is, was that sufficient?
It was absolutely necessary for this to take place. I mean, we were in danger of seeing a decline, a collapse of the world economy that would have taken us beyond what we saw in the 1930s. So the risks to global instability were massive, and the authorities both in the United States and elsewhere in Europe have recognized the vital importance of providing underpinning and support for our financial institutions. The financial institutions are the lifeblood of our economies. If we do not have properly functioning banks and financial institutions, then everything else